Hey everyone, welcome to the December 13th, Wednesday, 2023 Real Estate Note Investing Be the Bank broadcast. I am Justin Bogard, your host. And let's see, today we got some updates on kind of the foreclosures, on where we stand with foreclosures as it stands, through the nation right now. Looking pretty good. Richard and I got some updates for the commercial real estate part, and so we'll go through that. And then we got a cool case study that Richard and I actually bought this loan I don't know, about 18, 19 months ago, and actually didn't pan out too well. So we're going to kind of walk through the story on that. And that'll be the bulk of our conversation today. So stay tuned. Hey, welcome
Gotta,
back.
gotta love that band.
Yeah, I love that band. That's right.
How much do you have to pay them every time to play that?
Just a couple Coronas. That's all it really took,
Geez,
and they're consistent every time.
I was going to ask you too. You got that clock on the wall over your left shoulder there, and it always says it's about 3 minutes after 3. You might want to put a new battery in.
No, at 3 minutes after 3, I want everyone to stay in the office. I don't want them to think that it's closer to 5.
I mean, yeah. I know you're trying to cut corners, and little dude, but geez, put a battery in your phone, in your clock.
It could be AM. I don't know. You never know.
Well, it's going to be twice, right? Twice a day, right? But
it's true. It will be. All right,
so what do we got today?
Well, like I mentioned a few minutes ago, we're going to talk about some commercial real estate stuff, what's going on in that space, and I get my information, as you know, from Black Knight Financial Data, who is now ICE, and they have taken over the Black Knight stuff. So Black Knight still does what they do and sends out reports. It's really cool. It's got a mortgage heartbeat on what's going on right now, and it's usually got tons of information in there. I just kind of grab some things that are interesting to me, so we're going to talk about that for a little bit. But you and I recorded a podcast earlier today, and one of the things we talked about, which I think is cool to bring up now, is the fact that how the commercial office space, how it's kind of changing, and it's not going to get better for let's just say the landlord of the commercial office space. And you have spoken about San Francisco, on several of the podcasts and the broadcast. And obviously you and I had talked today a little bit about that. And what we had discovered was that some of these bigger players in the larger cities are turning these office buildings that are becoming vacant and the tenants aren't coming back, going to convert them into residential luxury apartments. And some of them even went to the extent of having understanding how the future of short-term rides are. I don't know, share rides, you would call them short-term or shared rides. And so they'll actually have the vehicle, whether it's autonomous or not, actually drive through the building to pick up the residents and then be able to drop them off there as well. So I thought that was kind of a cool little twist, keep people downtown. Where I'm at in Indianapolis, Richard, as you know, we have the millennials like to be downtown because they like to walk everywhere and ride little Lime scooters. I'm not sure what they do in Petaluma or in the Bay Area, but what did they
do you know, a little sidelight, do you know why Uber calls itself a ride share as opposed to a cab company, taxi company?
I think it has to do with legal.
If they do that, when they started out, the San Francisco taxi cab authority, I can't remember what that's called, actually tried to regulate them out of business. And they suddenly said, guess what? We're not going to be a cab company. We're going to be a ride share company. And there is no legislation for that. So, take that. And kind of, they didn't use those terms. They were
right. I fill in the blank, right?
Fill in the blank. Yeah.
What is it like going to San Francisco right now in the downtown area versus what it was, let's just say 8 years ago?
It's pretty vacant. The financial district during the day is is like it would be on a weekend, because the
Yep.
financial district, that's all there is down there. And it used to be a real hustle and bustle and really, really busy. And, now the sandwich shops are few and far between, and they've only got 10 patrons, and it's pretty dismal.
So you live in Petaluma, which I believe you mentioned to me before is kind of north and northeast of the Bay Area, right? For
Mhm,
geographic
mhm.
location. And
Yeah,
what
it's considered the North Bay Area, but yes, it's an hour north of San Francisco.
so do they have like a small downtown or like a main strip area in Petaluma?
We do.
And what is that like compared to the Bay Area? Is it similar to where it's starting to dissipate?
Well, so I mean, we have office space here, but it's
Mhm.
way out in the burbs. I mean,
Okay.
Petaluma itself, um, probably sort of like areas around Indianapolis. And Petaluma itself, the downtown was built in the 1850s to 1875.
Yeah.
So that's low lying, and that's sort of Nido Kino touristy, that type of thing. Um, the outlying areas actually, they've got a long-term clients out there. So um, it's kind of surprising. You wouldn't think, but Amy's Foods. You go to the freezer compartment. They have Amy's, vegetarian food and all that.
Okay.
They're based, and there's some good middle-sized national companies that are based out there. And they take up a lot of space in those places. So actually, vacancy in places like that is not all that high. It's pretty good because they've got longer term plastics companies and things like that. They don't really have office space like you'd have downtown in the financial district.
Gotcha. Yeah, Indianapolis, it's not. I really haven't noticed downtown that much because honestly, I haven't been down there. I will be down there this weekend
Mhm.
because Purdue and Arizona play basketball at the where the Pacers play downtown. It's kind of a special called the Indy
Okay.
Classic. So it'll be a pretty cool thing to go down there. And the Colts are playing at the same time too. So talk about traffic jam down there. They start at the same time, so it'll be
Oh my
interesting.
gosh.
Yeah,
You'd think they'd be better off. They could have better planning than that.
I know the problems in note investing right now, right? So,
That's right.
all right, let's transition into our little PowerPoint so we can go through our part of the presentation that we promised our viewers here. So hang on.
Okay. Okay.
As I figure out my PowerPoint button, start to get it to work here. There we go. Okay. All right. So we have some sponsors for our broadcast here. It wouldn't be possible without some sponsorship. And the sponsors are none other than American Note Buyers, right? We have a note deals area, our trade desk operations at andbfunds.com. If you're looking for notes, long-term notes, short-term notes, looking to lend money, that's the area you want to go to. We do sell partials every now and then as well. We probably do more hypothecations than we do partials right now. Cyria is our local real estate association company. They are a sponsor for this meetup / broadcast viewing for note investing as well. And there's their information. You can sign up with them. Richard and I and Larry and Mariska, I think it was 3 years ago right now, right before the pandemic, we came up with a course called Constant Cash Flow. And it's just note investing training. And what you can do is you can get the foundational knowledge of how to be a note investor. And we kind of walk through the performing and non-performing aspects of it, seller financing and partials and hypothecations, just talk about all the basics so you can kind of figure out where you want to go in this note investing space, or just kind of learn what it is that you can do in it. And it's a great tool. We have about 25 plus videos on that. You can sign up for it. I think it's around $300 to $400 right now. If you
Mhm.
email info@ambfunds.com, we can get you more information and a link to sign up if you want. And then our self-directed IRA company is our last sponsor. It's New View Trust. They're out of Florida. They're actually having an AltsCon here in February, Richard. It's a get-together, and Jason DeBono, the president, and then the founder is also going to be there. And they're going to be going over a lot of cool things about what NewView does, and also, things that you can do in a retirement account that's self-directed. Anyways, if you're interested in having a new self-directed IRA company, new accounts at newviewira.com. Don't forget to mention this broadcast, and they will waive your setup fee for that. About that, we talked about our podcast earlier. Our podcast is called Be the Bank. If you look at that logo and that name on any podcast directory, you can download our podcast and subscribe. We've been doing it for 5 seasons now. Richard and I just ended the 5th season today with the last recording of the year. And then we're picking up season 6 in January. Surprise, surprise. And so, yeah, it's pretty cool. It's about 20 to 30 minutes long per episode. They come out every other Wednesday, and it's for your listening pleasure. You can also watch the video stream of that on our YouTube channel here, on American Note Buyers YouTube channel. If you happen to be here, it's another playlist on here called Be the Bank. Pretty simple. Okay, foreclosure inventory. So I thought this graph was pretty cool. Number one, it was colored and shaded in, so it got my attention because, it doesn't take much to get my attention. If you notice, the blue shaded in area is the foreclosure inventory. And then the foreclosure line there just shows the percentage of it. So as we look, and historically, if you've been alive since 2000, you probably know about the great financial recession there. And you can tell that from 2007 started to get really bad up to 2010, 11, trickled into 12, then it started to come back down. That was the inventory that was actually foreclosed on, which was quite a bit. And the percentage of the amount of mortgages that this company aggregates here is now only about 0.5% are actually in foreclosure or being foreclosed on. And beforehand, it was almost about 4.5% to 5% of the inventory was actually total mortgages were actually being foreclosed on, even though we know the delinquency was around 11%.
Right.
So what does that mean? It means that we're not in any sort of trouble right now as far as having a big reset with real estate. Everything looks pretty good right now with real estate. As far as I can tell, I'm a Midwest guy. That's really the stuff that I look at. I'm not looking at outliers with Florida or New York area or out in California where Richard's at. Everything looks pretty steady, kind of rising as normal, as expected. Different pockets are accelerating faster than others, but for the most part, the inventory of foreclosures is kind of non-existent compared to what it was 6-7 years ago. So what's it like out there in good old California?
Well, I'd say the market is spotty because days on the market is longer than it has been. But we're still in the right house gets the right price. So if you've got a property that's not well priced and not very zippy, it's sitting. But if you've got a house that even has an aggressive price on it, one sold down the block from me here, and it went for $140,000 over asking. So it really just depends on the house and the pricing.
I thought you were just going to say it went for 140 and then drop it. And I was just about to fall out of my chair and be like, what happened?
No, that's over.
Yeah,
it went for over $1 million.
That was 40 years ago, right?
Yeah.
All right. If anybody has a comment about anything we're talking about today or any question that you have, don't hesitate to use the comment section on whatever social media feed that you're watching this on, whether it's on YouTube, Twitter, my LinkedIn channel, our Facebook group, or just on Facebook at American Note Buyers. Go ahead and make a comment if you want to say hi or whatever. We welcome that as well. So, okay, Richard, I'm going to hit the next one. This one I thought was pretty cool because the purple shaded, well, it looks like purple on my screen. The purple shaded area shows basically where the underwater is, if you want to call it that. The light blue is where the equity is. So CLTV, Richard, correct me if I'm wrong, but that's combined loan to value.
Yes. Mm-hmm.
Yeah. So it's the current combined loan to value of 90 plus days past due or in foreclosure. So it's saying, some of these are getting underwater, and that would be the purplish ones. And I got some data here I wanted to read. Let me switch screens on the background here.
I think you just like the colors on the graph.
It does. It's pretty. It's like a nice, what was that, sine wave? That's what I'm thinking of, a sine wave, just kind of rolling sine wave there.
Right.
So entering Q4, 58% of such loans had more than 20% equity, down slightly from a 64% share 2 years ago, but still strong. Today's market is a far cry from one seen in the depths of the great financial crisis when 90% of all seriously past due mortgages were underwater, in many cases significantly so. You can see by the graph up there, if it's got more purple in it than it does blue, then you know it's really bad as far as being underwater. Like we've mentioned before on this broadcast, and I think we talked about on the podcast several times, we're nowhere near a problem right now as far as
Right.
mortgages being underwater. In fact, I think it's a very rare thing if you see a mortgage underwater right now. One would think that it was just oversold recently, and that I can definitely see that being underwater. But if it was sold a few years ago, I really have a hard time seeing how it's underwater already today. And our case study is going to show some of that today as well, which is going to be kind of fun to get into. Sorry, I take a drink. Do you see anything else on the slide that stands out to you that I kind of missed? I just wanted to highlight the underwater part.
No, I think you did a good job of summarizing it.
Okay, thank you. I appreciate the vote of confidence. All right. This is a seller finance purchase case study. So background here, Richard and I tried to do some text messaging campaigns in about 2.5 years ago. And so we had some success with it, and we found some deals, and this was one of the deals that we found. So how it works was that we just send out some text messages to some people that have recorded some seller finance notes. This one happened to be in Michigan. I think we did some in North Carolina, South Carolina. I want to say we tried Tennessee. I think we did Indiana and Texas and a couple other states. And so we found some good deals this way. We came across this deal. It's in Cass City, Michigan, which I think, Richard, if you're looking at the mitt on Michigan, I think it's more closer to the thumb than it is to the bulk of the mitt. So if you think like the north and kind of, I guess Detroit would be really close to Windsor, right? Which is on the far east side of Michigan. And so this place is kind of, if you go a little bit west and a little bit north, that's about where Cass City, Michigan is. So it is a rural area, but it's, I don't know the population and the demographics off the top of my head. But anyways, so Richard, you came across this person via text message and you're kind of chatting with them back and forth. Obviously you don't need to mention their name, but what was that conversation like to get them or to understand that they wanted to sell their note to us?
Well, this lady in this case was, she didn't want to reveal it, but she was about ready to pull her hair out. She had been having problems with this borrower. She's being jerked around. She was in way over her head. And so she kept being coy with us for a long time about, oh, gee, maybe I'll sell it and blah, blah, blah. But as we got into negotiations, we found out that it was really, as far as she was concerned, radioactive. It wasn't something that we couldn't handle easily, but she, not knowing real estate, was having problems.
All right. So you finally got her to release some information to you so that at least we can run some numbers. And then I'm sure I ran some numbers for you and got back to you. And then what was that conversation like with her?
Well, yeah, we went back and forth for a long time. And actually, as quite often happens in these instances, it just went dead. And she didn't like our price. It was too low. She, thought she could do better elsewhere, even though she was having problems and things like that.
Yeah.
And then eventually she came back around, and I think I re-pinged her, and she said, I need to do something here.
Okay. So that's kind of when it turns over to me after she kind of accepts the offer, right? So funny story is that it's always a tale of two tales. And so Richard gets a story from this motivated seller, and he tells her things about this. And of course, she tells Richard things about this deal that kind of aren't exactly true. And so then I get on the phone, and I'm kind of the due diligence person with with the seller here, and I'm trying to verify facts and asking for information and documents so I can verify what she says is true and accurate. And then, lo and behold, the borrower doesn't pay on time. The borrower
Right.
is habitually late. As a matter of fact, they've skipped a few payments. Oh, by the way, they're behind on their taxes. I don't think the property's insured. And so you hear all this stuff and you're going, okay. Which is why, we price it the way that we do, because we anticipate some of these things happening, because they just never pan out exactly and perfect as Richard and I would like to see these notes when we buy them. But as you can tell by the picture, Richard, you know, it looks like a pretty nice piece of property. In
Yeah,
fact,
nice little house. Yeah, she used to live in it, and it was classic. She moved to another place and kept this one and had a very low basis in it. But you're right. I mean, she kind of didn't give us the full story. I quite often get the happy story, and you get the sad story. It's a
I
good way to
get
put it.
reality.
Mm,
It's like going to your therapist. Before you get there, you have this game plan, and then when you get there, you just go, "Oh God, the truth comes out."
that's true.
But I mean, you can see it looks like a Cadillac Escalade in the driveway. Like, so you're just thinking, okay, this property's kept up pretty well. It looks like a good piece of collateral. I'm pretty happy with that. Let's kind of move forward. So you get the conversation, and she kind of accepts the offer. I'm moving in there, getting information and realizing, okay, this borrower is going to be a challenge. We can sense that, and we've dealt with this before, and it's not a big deal. But I anticipate something, and you and I talk about this. And I said, "Hey, Richard, this is a land contract right now. This borrower is a challenge to her. She's obviously wanting to get rid of this. We don't really know if it's just maybe a disconnect between the seller and the borrower, just don't like each other, and maybe just coming into our portfolio, they'll have just better service. So we decided that the land contract just wasn't written well. And so we said one of our stipulations to move forward was that we want to convert this to a note and mortgage. And so I got permission from the seller to talk with the borrower and just kind of do what we call an estoppel. And so I was talking with the borrower saying, "Hey, is this true and accurate? Do you owe about this much money on the land contract? Are you aware of this, that, and the other?" And, the answer, yes. And I said, "Okay, this is what I'm proposing to do, and I need your permission to do that along with the lender." And I was telling the borrower that, we'd like to convert this to a note and mortgage because, quite frankly, we don't want to be on the deed. We'd rather you be on the deed. And then if you allow us to, we can take some of these problems that you have and we can add them to the loan, meaning, some delinquent taxes and whatever else they were behind on. And I was like, we can make this payment a little bit more affordable for you and package it up. But the catch of it is that you need to come to closing with a little bit of money and the first payment due. And then we can sign this contract and it'll be done and over with. And we can kind of move forward with this new little deal here. And they were happy to hear about that. They accepted it. The lender was happy to hear that the borrower accepted the opportunity. We kind of move forward to closing. So that's kind of where we'll pause for a second. So I'm going to go ahead and get the slides caught up here. So we had anticipated this property being worth about $80K when we were underwriting it. And so like Richard and I just talked about, we had a very motivated seller. We negotiated to convert this thing to a mortgage before purchasing. Now just for the audience's sake, Richard, why did we feel more comfortable converting to a note mortgage as opposed to leaving with a land contract?
Well, mortgage is obviously a better instrument, right? I mean, it's much more secure, and
Yeah.
yeah, anybody would want to do that. But you said something that was key, and I've thought of a new side business for us. You had the house there, and it had the Escalade next to it, and so that gives us a feeling of it being a nice house. We've got to start a new company and call it Note Staging. So when
Note
anybody
staging.
gets ready to sell their note, we'll drive a Cadillac and put it in the driveway, get some fancy, outdoor furniture, nice teak, all this kind of stuff,
Yeah.
and we'll jack the price of their notes up for them.
I like it. Michael had a quick comment about submitting pay history. Yeah, I didn't get a chance to mention that yet, but thanks for bringing that up, Michael. Yeah, so what I do in those situations is I ask them, like, typically they're not being serviced by a professionally licensed loan servicer, which is another reason why we discount these things so much. So we just get the best financials we can from them, whether they're copies of checks that deposit into their bank account or the actual bank statements that show the money being deposited in there. And we kind of create our own pay history on a spreadsheet, and then we just make sure our calculations make sense. So when we board it with a servicer, it's going to be compliant, and they can move forward. And so that's kind of what we did. Sherry, I did see your comment up there about the small print. I'm sorry about that. I'm sure you were talking about the slides. Excuse me, that we were talking about with the foreclosure stuff. We'll jump back into that at the end when we have our Q&A session there. So Richard, yeah, thanks for explaining that. We always love the note and mortgage as opposed to land contract. So if we get an opportunity to convert it and change it, obviously we're going to do that at the seller's expense. Talk with the borrower, like I mentioned. We close on the loan sale. Everything's kind of hunky and dory at this point, and we get to board it with a licensed servicer. So here are the numbers of the deal. So they were slightly different before we converted to a note mortgage, but I figured that information wasn't necessary for this. We just want to talk about the actual note and mortgage that we bought. So we kept the interest rate the same. We made the unpaid principal balance whatever he owed on the land contract, plus anything else that we had to add to it. Like, I think, Richard, was it closing costs? It was delinquent taxes, but they were, a few $100. They weren't that big a deal. And then something else, I don't remember exactly what it was. Anyways, it ended up being 55.6 was the total balance. Is a 7% rate. We made the principal and interest $400, so it's a very affordable payment. Mm-hmm. And we did it over 286 months because we tried to mirror what the borrower had left on their land contract, so that he wouldn't feel any different, just to get them to agree with this so we can move forward, because we'd much rather have the note and mortgage than the land contract. And so then we got this under contract for about $41,500. So it's a pretty good little discount in there, but you have to understand, we've seen 1,000 of these before, and we kind of know how the story is going to end up. So we knew we had to put a discount in there because of some of the negative factors that we talked about already.
And there were just a few, as you found out.
Yeah, it is funny when you get the story and you report to me, then I follow up with the diligence and ask these questions like, "Oh, Richard said whatever, he got a great pay history." Well, he kind of missed, what? He's actually 2 months behind. It's just one of those things. It's funny.
Right.
Okay. So the borrower did bring the first payment to the closing. Let me pause right there because I just remembered this part. So this set the tone about the borrower's character here. So the borrower was not a phone dodger, but he was an excuser. So he would come up with excuses about, I'm in the hospital because I've got, I'm really, really sick. Oh, now I'm out of the hospital, but now I got COVID. And so now I got to be quarantined for a week or something like that. And then he said something about, my vehicle broke down. Like, it was just excuse after excuse. So it actually took us like 60 days to actually get him to the closing table, but we didn't obviously fund the deal until he got there. So I just wanted to bring that up. That kind of set the tone with the borrower, and you could probably figure out how the rest of the story is going to go based on Mr. Excuse here. So he went dark right after that. We pretty much boarded with the servicer. He gave us the first payment. He went dark, and we tried to start foreclosure, and then he was smart enough, because he knew how to play the game, to make a payment. And I think, Richard, it was after 4 months he made a payment. And so then we ended up accepting it. And I kind of wish that we wouldn't have, but we did. Because we like to get people.
What I didn't like was the little recording that he sent us that went nanny, nanny, nanny.
He went like this after he turned it in.
Yeah.
Nanny, you got to start over again. And so sure enough, he did go dark again. The story as it ended up, I didn't get a chance to talk to him too often, but when I did, the information that I got was that was his childhood home. Okay. Mm-hmm. That's what he told me. And then he was able to get it back. And then his parents either had went to the hospital or one or both of them had passed away recently. And so he inherited their house, which is like down the street from this house. So he was actually living in his parents' house, and his son, who is, let's just say, his early 20s, was living in this house that is the subject property of what we're talking about today. And his son was supposed to be paying the dad rent so the dad could pay the mortgage. And so that really wasn't happening, is what we found out. And so then he went dark, and we just said, nope, we're not going to play this game. We're going straight through foreclosure unless you can pay in full, and then just kind of move forward. So quite a bit of time has gone through. In Michigan, luckily, foreclosure happens pretty quickly. So we didn't have to wait too long once we got it to that process. I did find out that we went to the foreclosure steps. It did not sell at the foreclosure steps, which I was very surprised. The borrower, Richard, was actually there at the sale. And when he discovered that it didn't sell, he called our loan servicer and was telling them that, hey, I know the bank owns this property. It didn't sell at the sale, blah, blah, blah. And I'm just thinking, like, you made all this effort to go to the sale, but you don't want to get the mortgage caught up. Like, you're concerned about losing your house. It's just funny. So the servicing company says, hey, look, you owe this much money and you can have it back. Now, again, this guy's smart. And so he didn't have his son move out, because there is a right of redemption period of, Richard, I think it's 6 months in Michigan.
Mm-hmm.
And so now they can squat another 6 months. So I had to wait for the redemption period to get over with. And then I was able to start eviction at that point, which is another process. So I had to verify that the home was being occupied by somebody. And once I verified that, I could have start the eviction process. Now I had some problems with our attorney, and 3 weeks went by before they started the eviction. So that was another irritable factor on this. And so I finally got to the eviction, and we were able to get to that step to where the judge finally agreed with all that stuff. So this is the mess that we found out in the property. They pretty much left everything in there, and they didn't even bother to move anything out. They just kind of either lived like this or just said, forget this. Let's just throw all our junk in here and let the bank deal with it. So there was a detached garage.
Don't you wonder about that, Justin? I mean, I've had a couple of foreclosures like this, and you look at the house and you go, could somebody really live like this? Why would they live like that? Why would they, come even close to living like that?
I don't know. I think they basically were living in this property for a good 18 months without really making any payments.
Mm-hmm.
The last picture there that popped up, notice the hot tub in the back. That is the only thing that the company I used to clean this place out that they couldn't get rid of because it was too heavy. So when we end up putting this up for sale, that comes with the property as maybe a bonus. So
I can tell you from experience, since I have a hot tub in my backyard, that empty, they weigh about 600 to 700 pounds, depending on the model.
It's crazy.
So
yeah, they said they did empty it, and they couldn't. They had 3 guys there, and they said they couldn't get it. They said,
you got to have at least 6 guys.
Yeah, I said, it's not worth it, man. Don't break your back. Just leave it there. It is what it is. Anyways, I think it was 3 full dumpster loads of garbage in there. We had to have a company come in and winterize the property afterwards. We had to change the locks. We did all that. We spent tons of money on that clean out. The clean out actually only took 2.5 days for them to clean it out.
Right.
But it was quite a process. We found a local real estate agent that was an REO specialist. They were able to list the property for sale. We listed it kind of high just to see what happens. And it didn't sell very quickly. And I had to lower the price quite a bit to get it to sell. So let's go over those numbers. So the judgment, which for those of you that don't know what a judgment is, as a lender, when you foreclose on a property, before you go to the sale, you pretty much gather up all the information that you are allowed to collect. So it's the unpaid principal balance. It's any advances that you made for like insurance or taxes or any loan charges or any parts of the foreclosure that you can add with your attorney's fees and stuff. Compile all that together, and you can make a full judgment amount to say, this is what I'm willing to sell it for at the sale. Now, you don't have to give that high number. You can give a lower number. So Richard and I agreed that we didn't want to hold on to this property any longer than we had to. So we said, instead of it being like 60, I don't know, 65,000 or $60,000 of the full judgment, we said, all right, let's just say 53,000, and somebody can just take this off our hands and then, not have to deal with it. So nobody bought it for 53,000. So I had calculated we had about $9,700 in advances in there, which isn't bad considering what you looked at. It was some delinquent taxes. It was there were some code violations because the city had to come over and mow the grass and clean up the yard, I think. And then obviously attorney's fees, and then whatever it costs for the good old boys to come in there and clean everything out. And so the timeline from this, it lasted about 18, 19 months to get to the REO sale. And so we finally got under contract for 62,000 for the sale. I did have it listed for, I think, 75,000. I even offered seller financing as well. And so I had to put it down to 62 for somebody to offer it. So just think, if they just would have went to the sheriff's sale, Richard, they could have had it for 53.
I know.
They could have saved themselves some money.
Mm-hmm.
So yeah, the good news is that it's officially sold. We already closed on it. So we actually ended up making $2,900 on this property when it's all said and done. We had virtually zero cash flow though. We had to hold it for 18 months. So it wasn't a good return at all. But the silver lining in here is that we didn't lose money.
Right.
I may have lost more hair than I wanted to, but but we didn't end up losing money, which was pretty cool. So Rich and I have done enough of these deals to know that when we're bidding on them in the beginning, we can kind of sense what's going to happen. And so we kind of anticipated something like this could happen. And that's why we're able to bid on it as low as we did. So we did get we knew that if we won the bid with the person that was selling it, that we'd have to deal with some crap, and this would help mitigate some of the crap. So we were hopeful that the borrower would have kept paying, and this would have been a very profitable, very high yield investment for us. But on the flip side, the worst case scenario happened, and we still walked away with a profit. So that just goes to show how much protection you can get as being the lender on this stuff. Granted, this wasn't a horror story. This wasn't an absolute horrible nightmare. This was a pretty tough one to go through, and it's not something that you want to go through. But if this is the worst thing that happens, I'm okay with that too, if this is worst case scenario.
Right. And one thing that's very interesting that you haven't said, and isn't said quite often in these instances, but you did say that Michigan is very quick to foreclose, very easy to foreclose on.
Yeah,
you're right. But look at the whole process. As you said, it took over 18 months to get this done. And I think a lot of times beginning note students get into this. They want to foreclose. They want to only have properties in Texas or wherever because they can foreclose so quickly. And yes, you can foreclose quickly, but you've got all these externalities that go along where you can get played. I've got one where I'm being played right now in St. Louis.
Yeah.
And it's very easy to foreclose. I've done it before. You have to go in with eyes wide open.
Yeah. So it could have been a little bit faster if I wouldn't have let that one payment trickle in, and we could have started foreclosure. So this probably could have been 3 or 4 months faster. If I would have stayed on top of the eviction attorney a lot better, we could have saved a month there. So I think best case scenario, we probably could have got this back in, maybe 12 months as opposed to 18. But then again, 12 months is still a long time. Yes, in Michigan, you can foreclose within, 3 or 4 months pretty quickly, but you have that 6-month redemption period. So because it wasn't vacant, we had to wait the redemption period. We are not allowed to go in that property and kick them out. We tried to call the sheriff to ask them to kindly ask them to leave, but he said, if I don't have a judge's signature on a piece of paper, I cannot do that at all. And I was like, I understand, but you had to ask, right?
Something else that just popped up to me that hadn't occurred to me when we were going through this deal is that the borrower told you that this is his childhood home and he grew up in it, yada, yada, yada. Well, the seller of the note told me she had lived in it for years too. So who's telling the right story there?
And now it could be possible that he grew up in this home, and then the home got sold to the person we bought the note from, and then they in turn
Right.
happened to sell it back, and that could be a true story. But yeah,
Could be.
I'm beginning to turn up the lying radar here and say, look, this guy hasn't really told the truth from the get go, and I think
Right.
he's just trying to work the system. So who knows if his son was really in there or not. Anyways, we're done with the asset. We've moved on with it, and we've learned a lot from the story. And I hope that you guys gotten a little educational on, how things can go wrong, but also how you can prevent yourself from losing money on this stuff. Just a lot of time
Right.
and headache. So,
And
um,
so also, I mean, you're right. He didn't pay. He did everything that he could to be a jerk.
yep.
But he did contact the servicer. I'm actually surprised he didn't buy it at the steps, because I've had several of my borrowers go back and try and buy their own note at a discount.
So, yeah, I mean that would be a smart play for him.
Mhm.
They could have also filed for bankruptcy before the foreclosure sale.
Right.
They could have done
Right.
that as well, and then that would have dragged it on even further. Sometimes borrowers do that. Michael had a good question here. Can you reject basically the redemption period payment? So the answer is you have to accept the payment. That's the point of the redemption period, is to protect the previous homeowner to be able to redeem their property in that 6-month period from when I foreclosed on it. If that was the question that you asked, I believe I'm answering it correctly. So no, I can't reject the payment. It's just part of the law that's written. Like in Indiana, I think we have a 12-month redemption period here. So
One caveat on that, because I've gotten stuck on it, is you can reject it if it's not a full payment. So if it were a partial,
correct.
you don't have to
Correct.
accept it. Even if it's $5 short, you don't have to accept it.
Sorry. Yeah. Thanks you for the
Yeah.
clarification. That's correct.
Right. And
Um,
it's preferable, actually.
yeah. Sherry writes here, could have different outcome to have his first payment cover arrears to bring him current. Sorry if I missed that part, if you were attempting to reach out. So yeah, so we wouldn't have gone through foreclosure if they could have just brought the account current. That's definitely something that we like to do, because it shows that the borrower's definitely willing to stay in the property, and they'll have some emotional equity into it pretty quickly. So we would have definitely accepted that to make it to the make. We'd much rather have a cash flowing investment instead of something like this, to where we have to foreclose on it and not get any cash flow, especially in the fund. It's not a lot of fun when you don't have cash flow. So.
Also, though, if you're in arrears that much, um, the servicer is always going to apply those funds um, to the interest and not to the principal. So he kind of, any way you slice it, it's not going to bring him current unless it's fully paid.
Fully current. Yeah, not just one payment.
Right.
Right. Right.
Right. Right.
So the risk level on this, as we reflect on this deal here, we were at 52%. And ITV stands for investment to value ratio. And so that means that we invested $41,500 of our own money, and the property is worth about 80K. So we were in this property for about almost 50 cents on the dollar, if you can say that. So that made it a very sweet deal for us, so that in the event something like this happens, we were well protected to where we felt like we weren't going to lose money on this deal. The
Can you
borrower was
imagine?
already at a 70% loan to value, so we felt like they had some good equity position there in the property. And then we converting it to convert the land contract to a note and mortgage. Obviously, that was a yes. That was a big plus that we were able to move forward with that. And then the collateral just looked really good from the beginning, so we were pretty happy with it. It's just too bad the inside was pretty much trashed with just junk and debris and just random clutter crap. And I believe the appliances were taken out, and most of the walls were damaged and had mold in it. So it didn't look that great on the inside. So like you said, Richard, before, like who would live in this thing?
Right. Right.
So that's kind of the overall for that case study there. Hope you guys enjoyed that. If you happen to have any liens that you find that you can sell, land contract, contract for deed, note and mortgages, note and deed of trust, lease options, what have you, we do have a little QR code here you can scan with your phone. If you want to play this, do this replay on YouTube, you can catch this and scan it. That'll get you to our web form to where you can actually enter in the data of a loan that you want to sell to us or just to get a bid on. And we'd be happy to bid that for you. As long as it's a first lien residential, that's pretty much our bread and butter right there. The next time we're going to have a broadcast here, a live broadcast is going to be Wednesday, January 10th from 6 to 7 p.m. Eastern time. Follow us on social media, the American Note Buyers Facebook, Twitter /X account, and then we have an Instagram account as well. We didn't mention our fund too much today, but we do have a real estate fund that we manage. It's a $10 million fund, and we're buying all sorts of performing loans with this that are first liens, and we do buy and find a few non-performing as well. So if you're interested in that, you contact us at investors@ambfunds.com. If you want to sign up for any of our newsletters or be aware when we have our broadcast or a podcast that drops, don't forget to go to our website, ambfunds.com, and you can sign up there, and we can provide some information for you as well. We do have a Facebook group called Be the Bank Real Estate Note Investing. And that group is just a Facebook private group with a few hundred people in there. If you have specific questions about a deal, if you want us to bring a deal on one of these broadcasts to kind of beat up and talk with you about it, we're happy to do that as well. Don't hesitate to reach out for that. Richard, I'm going to pull the PowerPoint off real quick, and then we'll have some more little Q&A. So hang tight. All right, man, that went pretty well with the case study. So we had some good questions. I wanted to get back to our friend Sherry here. So Sherry, if you wanted to go over the information that I had about those slides, I'm happy to send those to you in an email or what have you. So I think I have your email address, but if you want to go ahead and email us at info@ambfunds.com, I'll write that in the chat here. And then I can send that to you if you want to. You don't have to.
Yeah, basically, I think it was the years, right? The years 2000 to 2024, if that's the one she's referring to.
Okay. It could be.
Yeah.
I just want to be able to provide information if she needs it. So if anybody has any questions, it doesn't have to be relative to today's broadcast, any note investing questions in general. Richard and I are happy to stick around here and answer some questions for you. But until then, Richard, what did you think about the overall profit on that deal? Were you surprised? I don't think I ever told you what the profit was on it.
I don't think I was surprised. I mean, the fact that the way it was going, the fact that we just broke even was a plus as far as I was concerned. But I remember you put in a whole lot of work on that, and it was just kind of one thing after another. And so I appreciated your handling the whole thing, and I think you did it quite well. But the guy was definitely playing us, and when somebody's playing with you, as I'm finding out right now in one of my St. Louis deals, even the courts sometimes just, I don't know, it's like they just don't pay attention. You go, Look, don't you realize that you're being played? We're all being played here.
Yeah, and then we got to think of it. We're one court case versus the 1,000 that they have in their doc, on the docket. So
Right.
it's a numbers game too. They're just trying to shuffle us in and shuffle us out. But yeah, it's a patient game. It's a hurry up and wait mentality is the best way I can say. So you want to do your best to give all the information to your attorney in the way that they want it, so that they are efficient in doing the next steps. Because I tell you what,
Right.
if you're not good with the attorney, treating them well with that, I know you have to pay them an exorbitant amount of money, but trust me, it's better them to do it than you to do it. I'm more than happy to pay a couple $1,000s for the foreclosure attorney to handle whatever they handle. No complaints on my side. And by the way, foreclosures cost typically around $2,500 to $5,000. Typically, they can be much more than that, but typically you're going to have to, We always we always anticipate about 5K in foreclosure costs,
Mhm.
just for the attorney, just so that we cover our basis there. Just if you got that helps you guys
So
out.
just for the audience's edification, um, what's your opinion on letting your servicer handle a foreclosure for you as opposed to doing it yourself directly with a lawyer?
So I'll answer that two different ways. And the way that I'm going to do it, I'm going to try to work with the attorney directly. I
Mhm.
feel like it saves time and it's more expeditious that way. You don't get secondhand information if I channel through the servicer and the servicer channels through the foreclosure attorney. If you're brand new to this, you obviously would want to use the servicing company primarily to help you, because you just don't know what you don't know yet, and so you have an unfair advantage. But as somebody that's seasoned like myself, I'm definitely going to go to the attorney if I can. If my service is really good at handling that stuff, like we use FCI a lot for our servicing, they
Mhm.
pretty much handle the communication with the attorney, and I'm usually copied on stuff that says, "Hey, do you approve of this?" But other than that, they're kind of pushing and pulling information the whole time, and which I love. So if your servicer specializes in doing that with the attorney, by all means, let them handle it. It's just less headache for you, and you could miss an opportunity to accelerate the foreclosure because they know some steps that'll be faster.
Yeah, I always get frustrated by not having firsthand information. And honestly, if there was any way that I could expeditiously get in front of the judge myself and
Yeah,
at least sit there and know more about the process, I would do that in every case because I just don't think that anybody in your stead um, offers the case as well as you can yourself.
yeah, yeah. You have intimate knowledge about all the details of it, right? Because you've been through it.
Right. Right.
Um, Good question, Michael. What was the biggest takeaway on the property that could have been avoided? Wow. Um, let's see. It probably I felt that there's a 50-50 chance that this borrower is actually going to keep paying us. I take people for their word. Unfortunately, that's probably because I'm a sucker. But I really thought this guy was going to come through. He was very communicative up front before we converted this to a note mortgage. He seemed pretty genuine in what was going on. He was thankful for us taking the time to help him out, to add things to the unpaid balance. And so I really thought it was a 50-50 chance that he was going to come through. I knew that we were protected enough with how he bought it that if he defaulted, like we were just sitting pretty good right there. So it was my biggest takeaway on the property that could have been avoided. Um, it was probably I probably shouldn't have let him made the payment that I had to delay the foreclosure another 3 to 4 months. That was probably my biggest takeaway that I should have avoided.
Yeah, that's a tough one, Michael. I mean, it's a great question. You can come up with a couple of shoulda, woulda, couldas
Yeah.
with hindsight. Um, but I've got one going right now in St. Louis that I've referred to several times. And I've thought, I'm just sick of this. I'm going to sell it. I'm going to get rid of it. But it suddenly occurred to me a couple of weeks ago. I thought, wait a minute, she can screw around all she wants to with this. If I sell the note, I'm going to have to sell it at a deep discount and I'm going to lose money on it.
Yeah.
But eventually, the court and I are going to catch up with her. It may take me another year to
Yeah.
do that. And when we do that, I'm going to come out whole on this deal. So as frustrating as it uh, is, I'll probably be $20,000 or $30,000 ahead. And if I get the whole house,
Yeah.
in my instance, the house is worth, I think, 140. And I've only got a $40,000 mortgage on it. So I will come out very handsomely if that's the case. So, tough calls to
Yeah.
make at different times.
It's being the bank is great and you have a ton of leverage and you have a ton of opportunity to make more money and have high security if you're willing to wait. Like you
Right.
said, Richard, if you're willing to wait, things typically pan out very well for you as the lender. If you're in a hurry and you're looking for fast transaction, this isn't the game for you. want to flip some non-performing loans or try to close them quickly. It just doesn't happen that way, which is why we have, minimum extensions on our fund, because we want investors to understand, like, we can't just pull out all the money we want the next day. We have to go through a process and make sure that we have cash flow. And we have to make sure that if we do have to sell some assets, or if we do have something go non-performing, that we allow for that time that it takes to go to foreclosure. Some states, you can get this stuff done in less than 6 months pretty quickly. In some states, it may take 2 years to go through. I think the typical timeline in California, Richard, isn't it 18 months just to go through foreclosure?
Yeah.
Not even including the other stuff.
Yeah, exactly. And I've seen some of them going for 4 or 5 years, and just kind of like, really? I mean,
Yep.
just too painful. As a friend of ours has said several times, Justin, being in notes, investing in notes is not a good way to get rich quickly, but it's a great way to get rich slowly.
It's a great
If
wealth,
you can
right?
do that, then that's great.
Right.
Yeah.
All right, my dude. Well, this was a great broadcast today. I know that you're going to miss the January broadcast because you will actually be in South America having a good old time vacationing. So
I'm going to be in the Galapagos saying hello to the blue-footed dodo birds, or whatever they are.
the dum-dum birds. Dodo dum-dum.
Right. That's
right. Do.
But I'll be back in February.
That's the Homer Simpson bird. Do.
That's right. That's right. That's right.
Play reacts there. All right, guys. Thank you so much for attending our broadcast today. And please check out the previous ones that we've done to catch up on other case studies that we've done. We've done case studies the last 4 broadcasts. So if you're looking for more case studies, not just from us, from other people that we work with and people that we mentor, I have brought case studies on here that we're working with them on. So it's good information. Have a great holiday. Have a very safe and happy New Year. And we will see you guys in January. So see you, Richard.
Bye.